I have a few announcements to make, and they are as follows. I would request your patience. As the financial year 2020-21, the year of the pandemic, was drawing to a close, the Indian economy was advantageously poised relative to the peers. India was at the foothills of a strong recovery, having regained positive growth, but more importantly, having flattened the infections curve. In a few weeks since then, the situation has altered drastically. Today, India is fighting a ferocious rise in infections and mortalities. New mutant strains have emerged, causing severe strains on healthcare and medical facilities, vaccine supplies, and frontline health personnel. The fresh crisis is still unfolding. India has mounted a valiant defense domestically and globally to ramp up vaccines and medical support and save lives. Simultaneously, shoring up livelihoods and restoring normalcy in access to workplaces, education, and incomes become an imperative. As in the recent past, the Reserve Bank will continue to monitor the emerging situation and deploy all resources and instruments at its command in the service of the nation, especially for our citizens, business entities, and institutions beleaguered by the second wave. The devastating speed with which the virus affects different regions of the country has to be matched by swift-footed and wide-ranging actions that are calibrated, sequenced, and well-timed, so as to reach out to various sections of society and business, right down to the smallest and the most vulnerable. While doing so, our admiration and gratitude goes out to the brave citizens of our nation, to our doctors, healthcare and medical staff, police and law enforcement agencies, and to other authorities who battle the second surge selflessly and tirelessly and have been at the front line for more than a year now. Their services to our nations are now needed more than ever. The quarantine facilities of the Reserve Bank of India continue to operate with more than 250 RBI personnel and service providers away from their homes to ensure continuity of various segments of financial markets and RBI operations. Since the pandemic began, I have on several occasions expressed my genuine faith in India's resilience and capacity to overcome all odds. To quote Mahatma Gandhi, "My faith is brightest in the midst of impenetrable darkness." And these are very inspirational words, not just for us in RBI, but I think everyone in this country. Over a year now, we have struggled to free ourselves from the pandemic's deadly grip. Between mid-September and February, as a country, we did manage to lower infections at a time when the rest of the world was reeling under the malevolent surges of the virus. This time around, we have to marshal our resources and fight it again with renewed vigor, ignited by the determination to overcome and to return to normalcy and sound health. Before I set out the measures that the Reserve Bank is proposing to undertake as part of the first part of a calibrated and comprehensive strategy against the pandemic, let me reflect on the macroeconomic and financial conditions that prevail, so that the context in which today's measures are being taken can be appreciated. The global economy is exhibiting incipient signs of recovery as countries renew their tryst with growth, supported by monetary and fiscal stimulus. Still, activity remains uneven across countries and sectors. The outlook is highly uncertain and clouded with downside risks. In April 21, the International Monetary Fund, IMF, revised up its global growth projections for 2021 to 6% from 5.5% projected in their January forecast, on the assumption that vaccines would be available in advanced economies and in some emerging market economies by the summer of 2021, and in most other countries by the second half of 22. World merchandise trade maintained its recent uptrend, growing by 5.4% in February 21 on a year-on-year basis. Consumer price inflation, CPI inflation, remains benign for major advanced economies. However, in a few EMEs, it persists above targets on account of firming global food and commodity prices. Global financial markets regained buoyancy in April on vaccine optimism after bouts of volatility in February and March, followed by corrections. Moving to domestic developments, aggregate supply conditions are underpinned by the resilience of the agriculture sector. The record food grains production and buffer stocks in 2020-21 provide food security and support to other sectors of the economy in the form of rural demand, employment and agricultural inputs and supplies, including for exports. The forecast of a normal monsoon by the Indian Meteorological Department, IMD, is expected to sustain rural demand and overall output in 21-22, while also having soothing impact on inflation pressures. Aggregate demand conditions, particularly in contact-intensive services, are likely to see a temporary dip, depending on how the COVID situation unfolds. With restrictions and containment measures being localized and targeted, businesses and households are learning to adapt. And this is something which has been very well noticed over the last year. Even with local containment measures, businesses, small businesses, and the big businesses, big and small and medium, I think everybody has learned how to survive and how to do business in an environment of containment, in an environment when there are physical restrictions, or rather restrictions on physical movement. With restrictions and containment measures being localized and targeted, that's what I was alluding to. With restrictions and containment measures being localized and targeted, businesses and households are learning to adopt. Consequently, the dent to aggregate demand is expected to be moderate in comparison to a year ago. Reports suggest that the disruption in manufacturing units so far is minimal. Consumption demand is holding up, with sales of consumer goods rising in double digits in January to March, and average daily electricity generation up by 40% year-on-year in the month of April. Rail freight has registered growth of over 76% year-on-year in April. Toll collections in April suggest that mobility has declined, but quite unlike the abrupt halt in mobility during April last year. Registration of automobiles in April 21 has shown some moderation compared to March. The tractor segment, however, continues its robust pace. The Purchasing Managers Index, that is PMI for manufacturing, continues in expansion mode at 55.5 in April compared to 55.4 in the preceding month, that is March. Overall, the high frequency indicators are emitting mixed signals. The RBI will closely and continuously monitor all incoming data to assess on a real-time basis the impact of the second wave on macroeconomic and financial conditions. CPI inflation eased up to 5.5% in March 21 from 5% in February, on the back of a pickup in food as well as fuel inflation, while core inflation remained elevated. High frequency food prices data for April 21 from the Department of Consumer Affairs, Government of India, suggests further softening of prices of cereals and key vegetables, while price pressures in pulses and edible oils remain. Price of petrol and diesel registered some moderation in April. Manufacturing and services PMIs, along with rising WPI inflation, show a persistence of input price pressures. The May 12 release of National Statistics Office will throw more light on inflation developments. Going forward, a normal southwest monsoon as forecast by the IMD should help contain food price pressures, especially in cereals and pulses. The build-up in input price pressures across sectors, driven in part by elevated global commodity prices, remain a concern. The inflation trajectory over the rest of the year will be shaped by the COVID-19 infections and the impact of localized containment measures on supply chains and logistics. But even at this time, in the run-up to the next MPC, when our teams are analyzing the various incoming data, and as I said, we are monitoring them on a real-time basis, we do not expect any broad deviation from the projections which we made in our April MPC, but you will have to wait for our MPC statement, which is due in the first week of June. In the external sector, India's merchandise exports and imports rose sharply in March of this year. For the year 2020-21 as a whole, the merchandise trade deficit shrank to US $98.6 billion from $161 billion US a year ago. Preliminary data released by the Ministry of Commerce and Industry, Government of India, indicate that India's merchandise exports and imports continue to witness broad-based robust growth performance even in April 21. The current account balance, which had been recording surplus from January 2020 through September 2020, flipped and turned into slender deficit of 0.2% of GDP in third quarter of 2021. Foreign exchange reserves were at $588 billion US on 30th April 21. This gives us the confidence to deal with global spillovers. Domestic financial conditions remained easy on abundant surplus system liquidity. The average daily net liquidity absorption under the Liquidity Adjustment Facility, that is LAF, was at rupees 5.8 lakh crore in April 21. The first auction of GSAP 1.0 conducted on 15th April 21 for a notified amount of rupees 25,000 crores elicited an enthusiastic response, as reflected in the bid cover ratio of 4.1. GSAP has generated softening bias in GSEC yields, which has continued since then. And as I have explained in the MPC statement, the GSAP is contributing to softening of GSEC yields, which in turn contributes to softening of the corporate bond yields and the private sector borrowing in the market. Given this positive response from the market, it has been decided that the second purchase of government securities for an aggregate amount of rupees 35,000 crore, I repeat, for an aggregate amount of rupees 35,000 crore under GSAP 1.0 will be conducted on 20th May, that is in about 2 weeks from now. With system liquidity assured, the RBI is now focusing on increasingly channelizing its liquidity operations to support growth impulses, especially at the grassroots level. Now I turn to the additional measures that we have proposed. In our fight against the second wave, alleviating any constraint from the financing side for all stakeholders, that is government, hospitals and dispensaries, pharmacies, medicine manufacturers and importers, medical oxygen manufacturers and suppliers, private operators engaged in the critical healthcare supply chain, and above all, the common man who may be facing sudden spikes in health expenditure. All these require a comprehensive, targeted policy response. Small businesses and financial entities at the grassroots level are bearing the biggest brunt of the second wave of infections. Against this backdrop, and based on our continuing assessment of macroeconomic situation and financial market conditions, we propose to take further measures, which now I will enumerate. The first measure relates to term liquidity facility of rupees 50,000 crore to ease access to emergency health services. to boost provision of immediate liquidity for ramping up COVID-related healthcare infrastructure and services in the country, an on-tap liquidity window of rupees 50,000 crores, rupees 50,000 crore with tenor of up to 3 years at the repo rate is being opened till March 31st, 2022, that is March 31st of next year. Under the scheme, banks can provide fresh lending support to a wide ranging of entities including vaccine manufacturers, importers and suppliers of vaccine and priority medical devices, hospitals and dispensaries, pathology labs, manufacturers and suppliers of oxygen and ventilators, importers of vaccine and COVID-related drugs, logistics firms and also patients for treatment. Banks are being incentivized for quick delivery of credit under the scheme through extension of priority sector classification to such lending, and this facility will be available up to 31st March next year, that is 31st March of 2022. These loans will continue to be classified under priority sector till repayment or maturity, whichever is earlier. Banks may deliver these loans to borrowers directly or through intermediary financial entities regulated by the Reserve Bank of India. Banks are expected to create a COVID loan book under the scheme. By way of an additional incentive, such banks will be eligible to park their surplus liquidity up to the size of COVID loan book with the RBI under the reverse repo window at a rate which is 25 basis points lower than the repo rate, or termed in a different way, that is explained in a different way, 40 basis points higher than the reverse repo rate. So this is an additional incentive that is being given to the extent that they are using this window and they are lending, and to the extent that is available in their COVID loan book which they are going to create. Whatever is the loan disbursed under that window, equivalent amount they can put it in reverse repo at a rate which is 40 bips higher than the normal reverse repo rate which prevails today. Second measure, the next measure relates to special long-term repo operations, SLTRO, for small finance banks, SFBs. Small finance banks have been playing a prominent role by acting as a conduit for last mile supply of credit to individuals and small businesses. To provide further support to small business units, micro and small industries and other unorganized sector entities who are adversely affected during the current wave of the pandemic, it has been decided to conduct special 3-year long-term repo operations, that is 3-year SLTRO of rupees 10,000 crore at repo rate for the small finance banks to be deployed for fresh lending of up to rupees 10 lakh per borrower. This facility will be available till 31st October 21. Lending, next measure relates to lending by small finance banks, that is SFBs, for on lending to SFBs for on lending to MFIs to be classified as priority sector lending. At present, as you would be aware, lending by small finance banks to microfinance institutions for on lending is not reckoned for the purpose of priority sector lending classification. In view of the fresh challenges brought on by the pandemic and to address the emergent liquidity position of the smaller MFIs, SFBs are now being permitted to reckon fresh lending to smaller MFIs with asset size of up to rupees 500 crore for on lending to individual borrowers as priority sector lending. This facility will be available up to 31st March 22. Next announcement relates to credit to MSME entrepreneurs. With a view to incentivize credit flow to micro, small and medium enterprises, that is MSME borrowers, in February 2021, the scheduled commercial banks were allowed to deduct credit disbursed to new MSME borrowers from their net time and demand liabilities, that is NDTL, for calculation of their cash reserve ratio, CRR. In order to further incentivize inclusion of unbanked MSMEs into the banking system, this exemption, which is currently available for exposures of up to 25 lakh and for credit disbursed up to fortnight ending 1st October 21 is being extended till 31st December 21. The next measure relates to Resolution Framework 2.0 for COVID-related stressed assets of individuals, small businesses and MSMEs. The resurgence of COVID-19 pandemic in India in recent weeks and the associated containment measures adopted at local and regional levels have created new uncertainties and impacted the nascent economic revival that was taking shape. In this environment, the most vulnerable category of borrowers are individual borrowers, small businesses and MSMEs. The following set of measures are being announced today, specifically targeting these groups of borrowers. And this particular set of announcements, there are three components to it. The first component is as follows. Borrowers, that is individuals and small businesses and MSMEs having aggregate exposure of up to rupees 25 crore and who have not availed restructuring under any of the earlier restructuring frameworks, including the Resolution Framework 1.0 of RBI dated 6th August 2020, and who were classified as standard as on 31st March 2021, shall be eligible to be considered under the Resolution Framework 2.0. Restructuring under the proposed framework may be invoked up to 30th September and shall have to be implemented within 90 days after invocation. In respect of, and the second component, now I am proceeding to the second component of this set of announcement. In respect of individual borrowers and small businesses who have availed restructuring of their loans under the Resolution Framework 1.0, where the resolution plan permitted moratorium of less than 2 years, lending institutions are being permitted to use this window to modify such plans to the extent of increasing the period of moratorium and or extending the residual tenure up to a total of 2 years. Other conditions will continue to remain the same. And the third component relates to small businesses and MSMEs which were restructured earlier, and this measure is intended to ease their working capital accommodation and the working capital availability for small businesses and MSMEs. And the announcement is as follows. In respect of small businesses and MSMEs restructured earlier, lending institutions are being permitted as a one-time measure to review the working capital sanction limits based on a reassessment of the working capital cycle, margins, etc. The next announcement relates to rationalization of compliance to KYC requirements. Taking forward the initiative of the RBI for enhancing customer convenience, it has been decided to rationalize certain components of the extant KYC norms. These include A. Extending the scope to video KYC known as video-based customer identification process, that is VSIP, for a new category of customers such as proprietorship firms, authorized signatories and beneficial owners of legal entities, and for periodic updation of KYC. B. Conversion of limited KYC accounts opened on the basis of Aadhaar eKYC authentication in non-face-to-face mode to fully KYC compliant accounts. C. Enabling the use of KYC identifier of centralized KYC registry for VSIP and submission of electronic documents including identity documents issued through DigiLocker as identity proof. And D. Introduction of more customer-friendly options including use of digital channels for the purpose of periodic updation of KYC details of customers. And further, keeping in view the COVID-related restrictions in various parts of the country, regulated entities, that is financial entities regulated by the RBI, are being advised that for the customer accounts where periodic KYC updating is due or pending, no punitive restriction on operation of customer accounts shall be imposed till 31st December 21. Unless warranted due to any other reason or under instructions of any other regulator, enforcement agency, court of law, etc. Account holders are, however, requested to update their KYC during this period. The next announcement relates to utilization of floating provisions and counter-cyclical provisioning buffer. In order to mitigate the pandemic-related stress on banks and as a measure to enable capital conservation, banks are being allowed to utilize 100% of floating provisions or counter-cyclical provisioning buffer held by them as on 31st December 2020 for making specific provisions for non-performing assets with prior approval of their respective boards. Such utilization is permitted with immediate effect and up to 31st March 22. The final announcement is relates to relaxation in overdraft facility for state governments. To enable the state governments to better manage their fiscal situation in terms of their cash flows and market borrowing, certain relaxations are being permitted with regard to availment of overdraft facilities. Accordingly, the maximum number of days of overdraft, that is OD, in a quarter is being increased from 36 to 50 days and the number of consecutive days of OD from 14 to 21 days. This facility will be available up to September 30th of this year. The Ways and Means advance limits of states have already been enhanced on 23rd April this year. The relevant circulars and notifications relating to all the announcements which I have made will be issued separately starting today. Let me now conclude and state as follows. The immediate objective is to preserve human life and restore livelihoods through all means possible. The second wave, though debilitating, is not insurmountable. As I have said earlier, it is during our darkest moments that we must focus on the light. We have lessons to draw from our experience of last year when as a nation we came together and overcame the once-in-a-generation challenge imposed by the first wave of the pandemic. At the RBI, we stand in battle readiness to ensure that financial conditions remain congenial and markets continue to work efficiently. We will work in close coordination with the government to ameliorate the extreme travels that our citizens are undergoing in this hour of distress. We are committed to go unconventional and devise new responses as and when the situation demands. We must also stay focused on our future, which appears bright even at this juncture, with India set to emerge as one of the fastest growing economies in the world. Today, we have taken some steps, we meaning the Reserve Bank of India. Today, we have taken some steps and we will continue to be proactive throughout the year, taking small and big steps to deal with the evolving situation. We must remain resolutely focused on a post-pandemic future of strong and sustainable growth with macroeconomic and financial stability. I call upon all stakeholders to come forward once again to address the challenges posed by the current wave of the pandemic while remaining on guard against future waves. In closing, I again quote the words of Mahatma Gandhi, and I quote, "Our faith should be like an ever-burning lamp which not only gives us light but also illuminates the surroundings." Thank you. Namaskar.
For more updates, please subscribe 99TV Telugu.